Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, it was an eventful week from a central bank policy perspective. There was, of course, the much-awaited Fed meeting, but let's not forget we also had some very important decisions from the Bank of England and the Bank of Japan as well. So it's a very policy-heavy week that's now very much behind us. The obvious question that's raised for investors, of course, is what's the next step in terms of implementable action? Should investors sit back or have these meetings created any opportunities? To discuss this, I'm joined by Fook Hien, who's a senior investment strategist at the CIO office. So, Fook Hien, thanks for joining us today. I guess let's start with the Fed. What are your main takeaways from the Fed action this week? And more importantly, what are the investment implications?
Yeah, hi, Manpreet, thanks. So, the Fed's plan to ease policy significantly over the next couple of years, it shows that central banks are increasingly focusing on supporting growth as inflation cools. The Fed rate cuts are likely to help the US economy achieve a soft landing. In this environment, staying invested in a broadly diversified allocation with an overweight to US equities remains attractive in our view. The bond yields and the US dollar, they are likely to consolidate in the near term after their sharp drop heading into the Fed meeting. So any rebound in the US government bond yields towards 4% would offer an opportunity to lock in attractive income over the long term. So the Fed has lowered its policy rate by 50 basis points from a 23-year high of 5.5%, and this was slightly exceeding market expectations. It was the largest rate cut at the start of a Fed policy easing cycle since 2007. The Fed, they also projected a total of 100 basis points of rate cuts by the end of 2024 and 200 basis points of cuts by the end of 2025. And they're able to do this as inflation is seen falling close to its 2% target by 2025. So after delivering the outsized cut, Fed Chair Powell sought to assure investors that the Fed would not fall behind the curve as the economy cooled. If we look at the economic backdrop, the US job market has cooled lately, raising concerns about rising unemployment. We now expect the Fed policy easing would be able to support an economic soft landing. And in this case, US equities, they are likely to benefit the most. The equity and bond markets have both gained going into the Fed policy meeting, suggesting that markets are pricing in a soft landing for the US economy. And historical trends, it shows that the Fed rate cuts that were followed by a US soft landing were positive for US equities over a 12-month period following the start of the rate cuts. We can see this in the soft landings back in 1987, 1995, and 1998. So we stay overweight US equities within a broadly diversified asset allocation. The Fed rate cuts are likely to lower borrowing costs for consumers and businesses. The US large corporate balance sheets, they remain robust and a corporate earnings outlook remains strong. And this is particularly in the growth sectors such as technology, where rising demand for generative artificial intelligence related equipment and software is driving structural growth. The lower interest rates, they also help to support valuations of your long-term growth sector equities. And we expect the technology sector to lead US equity outperformance. Within the bond space, markets are pricing in another 200 basis points of rate cuts by the end of 2025, on top of the cut that we saw this week. So if the Fed takes a less aggressive rate cut path, which is what they are projecting, this would likely lift bond yields in the near term. So we would use any bounce in US bond yields towards 4% to lock in an attractive income.
Thanks, Fook Hien. Let's stay with bonds for a moment because clearly this is not the first Fed rate cutting cycle. So what can we learn from history about the performance of bonds after a first rate cut of a cycle?
Yeah, so history shows that the bonds, including government and corporate or emerging market bonds, they tend to deliver positive returns on average in the 12 months after the first rate cut of a cycle. Hence, we would use any rebound in bond yields to lock in the income. Looking deeper into the bond sub-asset classes, we observe some variability in post-cut performance. So the credit assets like corporate and emerging market bonds, they generated a higher 12-month average return after the first rate cut, an outcome that could be attributed to the additional yield premium over government bonds. And within credit, the emerging market, US dollar government bonds, they rank the highest in terms of the post-cut 12-month returns. And this is likely because one, their sensitivity to falling US bond yields is high and comparable to that of the developed market investment grade corporate bonds. And two, their yield premium is relatively high and comparable to that on the developed market high yield corporate bonds.
All right. Well, let's move on now to the Bank of England. We had the BOE rate decision, and how do you see that, together with recent economic data in the UK, impacting our view on pound sterling and UK equities?
Yeah, the Bank of England kept its policy rate unchanged at 5% this month. We've seen core inflation tick higher in August. The manufacturing and industrial production in UK improved, and jobless claims also eased. So consensus expects the Bank of England to cut rates by another 50 basis points before year end. So we expect the GBP or the sterling to remain well supported, with the Bank of England proving to be less dovish than the Fed. While the positioning is relatively bullish, the momentum indicator like the MACD suggests a bullish crossover in the pound to the sterling, in the pound to the US dollar, GBP to US dollar, which is pointing to upward pressure on the pair in the near term. A firm break above 1.326 could pave the way for a test of the next resistance at a 1.348. For UK equities, no change decision on rates means that the financial sector, which is 20% of MSCI UK, it will enjoy higher interest income for longer. Beyond financials, UK equities, they remain relatively defensive, with sectors like consumer staples, healthcare, and utilities comprising 37% of UK equities versus 21% for global equities. Now, the lack of growth sectors like technology can limit relative outperformance, but we nevertheless like UK equities' attractive valuation and defensive qualities amid the prevailing uncertainty. So we see UK equities as a core holding, and we expect them to perform in line with global equities.
All right. And maybe finally, moving to Japan. Besides the BOJ meeting, of course, Japan faces an upcoming prime ministerial election. Do you see that having any impact on financial markets there?
Yeah, out of the total of 9 potential prime minister candidates vying for leadership of the ruling Liberal Democratic Party, the polls indicate a tight race among the top 3 candidates in Japan's election next week, namely Ishiba, Koizumi, and Takaichi. From an equity market perspective, we retain a neutral or a call holding view on Japan's equity market. On the positive side, we expect the expansionary policies advocated from the candidates ahead of the election mean that investor optimism on economic growth and equity market performance is likely to remain well supported. In addition, the resilient macro data, particularly the higher than expected real wages in July, it continues to support the cyclical nature of Japan's equities. And then improving corporate governance also support stronger corporate fundamentals. Having said that, the short-term volatility remains a risk as the prime ministerial elections, they create some uncertainty. The market also remains vulnerable to further strength in the yen, given the export-centric nature of the market. For instance, US dollar to Japanese yen is the move to the one-year low last week has dampened major export-related sectors. This has hurt the local currency denominated performance, although US dollar denominated investors have seen greater stability given currency gains have helped to balance equity weakness. That said, we see opportunities to add to Japanese banks, the sector on the pullbacks, as the BOJ's policy tightening bias is expected to support the net interest margins for the Japanese banks.
Okay, well, I guess that brings us to the end of the time we have today. So thanks very much, Fook Hien, for that insightful conversation. If I can summarize the key takeaways, I think number one is, of course, the Fed meeting being the big event of the week, but the opportunities from there, of course, consider opportunities in, of course, equities in the technology sector, and, of course, adding to bonds on any rebound in yields towards 4%. Second, of course, from the Bank of England, an important policy decision which we think will keep the pound sterling well supported. And finally, from the prime ministerial election, maybe watch out for some volatility in Japan, watch out for some short-term volatility, but really look to the fundamentals which justify our core holding. So we'll bring it to an end there. Thank you very much for listening in to today's podcast. We hope you enjoyed it, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.